Welcome back, guys and girls. So we're now in episode 3, part 3. As we said from the very beginning, we wanted to break this down into 3 stages, and each one builds on each other. And as now that you understand the core mechanics of the strategy, you understand how to enter the market, all of the patterns that we look at and utilize, it's now important for us to go into a little bit of psychology. This is not just understanding about fear and greed and things like that, because we have a whole episode later in the foundation series, but understanding the psychology of the market in terms of technical analysis. So as we dive deep into this, we're very excited. Get ready to sit back, absorb that information. Let's get into part 3. Right, guys and girls, now we are on part 3, so episode 3, part 3. So this is where we get into more of the psychology part of the technical analysis. Now, of course, we have a whole other episode on episode 9 dedicated to psychology, but it's important to understand different parts of that psychology. The first one being the 90% rule. This is very important. So let's begin with that. So what is the 90% rule? Essentially, the 90% rule is a concept, and it's a key component of the Falcon strategy. Knowing when this rule applies is crucial to maximizing on your profit potential. The 90% rule can be applied to both the higher time frame and the lower time frame. The key mechanics of this rule is to identify where the beginning of the correction starts. Let's say, for example, we're looking at an ascending channel for a short position. If the structure breaks impulsively on the daily or the weekly time frame, the 90% rule is activated. This gives us a very clear target, but also understand that the 90% rule means that price only has to complete 90% of the move towards the beginning of the correction. There is a process to understanding how to identify where this rule may apply. What we'll do now is we'll take a look at that at some clear examples on the chart, so you can see where the 90% rule comes in and how you can utilize it to your advantage. Right, guys and girls, so now we're in part 3 of episode 3 as we take a look at the first section, which is the 90% rule. This is one of the most powerful rules that we can utilize. This is used on the longer term, medium and short term. So you're going to see this on all time frames. So let's just dive straight into this. So here we have pound dollar, and we're going to look at the 90% rule. So what is it? Well, essentially, let's take a look at a few examples. So first up, let's take this bit of price, as we've got this ascending structure, as you can see. Now, essentially, the 90% rule activates and kicks in once we break a structure impulsively. So let's take this for example. We can see and identify that this is an ascending channel, as I'm sure you'd all agree. Now, with this ascending channel, let's just draw this on roughly. What happens? We break this impulsively, which is this section here. Once we break this impulsively, and that is the key, not correctively, impulsively, we then activate the 90% rule. Once that happens, we have a 90% probability that we will fill 90% of this correction. So by understanding that concept, think about how powerful that is for short-term, medium and long-term trades. Take pound dollar, for example. We looked at this, you can look through our previous webinars as well, when we were shorting pound dollar from the top, and we understood this rule. So we knew that, well, let's take a look at it. If we look at this in more detail, once we broke out of this structure and we just tighten this up a little bit. So as you can see, when we truly broke out of the pattern, this is of course one big ascending channel, but just getting the most recent touches, you can see we broke out impulsively. If we go to the weekly chart, you can see we closed impulsive candle on the weekly, and we followed that momentum. So that gave us an indication that we've got a long-term trade on the cards. That gives us a huge edge, so you're not cutting your trade short. Think about the extra percentage you're able to make by knowing this rule and understanding this. This is something that I figured out over the years of looking at pattern identification in a unique way. But let's go into a little bit more detail. You can see this has filled this already now, because we're pretty much at the low, we've rejected and moved off, and we have another potential 90% rule to activate to the upside. But let's take a look at this in a bit more detail before the drop. So we've seen this on the larger degree, and this is more longer term. You may not hold that trade the whole way because there's many entries, many multiple entries along the way, but it just shows you the longer term potential with it. But before we dropped, we had the double top. And then what else did we have? We had the very clean third 3 touch of ascending channel. Let's just tighten that up. So 1, 2, 3, ascending structure. And then we look at the same rule. So this is on a slightly more shorter term. What do? We break impulsively. If we take price back to here, we've broken impulsively with this momentum out of this structure. So now we have a 90% probability that we will fill 90% of this correction. Now, the majority of the time we fill 100% of the correction, but as a little discrepancy, so you understand, it doesn't have to fill it 100% of the way. Generally speaking, it does, but just so you're aware and you're more on the ball with management when you're in these areas, just in case. But with this one, we were looking at this as more as 100% completion. Why? Because the 90% rule that we're looking at is all the way down here. So this one was a no-brainer to be looking for the sell as an absolute minimum targeting here. Now, why is that of use to you as a trader? Well, imagine that you're taking trades around these areas and you're closing them down around here, knowing full well you're essentially missing out on all of this profit for pretty much no reason, from a lack of knowledge. But now you have the knowledge, so you can apply yourself with that. So quite simply, if we break impulsively out of a clear ascending structure or descending structure, it works both ways, then a 90% rule activates for us to get to the low. So always identify where the beginning of the correction is. That is the key. So that is pound dollar, guys and girls. Let's take a look at some other examples so you can see that. So here we have a dollar CAD. This is another example to understand the 90% rule. Now this was another trade that we looked at from a longer term perspective within Falcon. Again, feel free to go back at the older webinars to understand the thought process on this. But as you can see, what do we have? Well, within this episode, you've learned about your flags. Now this is a much larger flag. So if we look at this as an impulse, a much larger correction, but ultimately what pattern do we have here? Impulse correction, huge bear flag to the downside. So if you think about the 90% rule right now, try and think about where that would activate and what clarity that will give you. So if we zoom in and we put in the bottom of the trend line, as we can see, like so, then we ask ourselves, on the break of this, did this break correctively or impulsively? As you can see, if we just zoom in, we break impulsively. Now, it doesn't mean that if the first candle is slightly small, then that means it didn't break impulsively. It's more so around that area. So you can have a slightly smaller candle coming out, but then if you see within that area that there's clearly an impulsive break in general, that activates that rule. Then what do we look at? We look at the beginning of the correction. So we could all agree, as I'm sure you all would, that this is the start of where this corrective structure started. So then what have we got? Well, imagine you sold this from here or from here or from here. There's multiple entries in this impulsive leg. This is actually one of our biggest legs. But you imagine that you're infatuated with, let's say, a support if you've come from a different style. You know the 90% rule is activated, but you're closing your trades down here, or maybe closing it here or here. You could find multiple ones. But knowing that there's a 90% probability to play out to at least the low where we may start a bigger correction, as you can see, that is powerful. And when you look at it from this perspective, you know, that's 770 moving towards 1,000 pips. But as we know, we don't calculate in pips, but it's important that we use that to understand the range of that. So if you think about it, the percentage is what's scalable, but you can see what room we had to breathe there and what we could capitalize on. So it's just about understanding that bit of price. And again, as a great exercise, just looking at the structure, utilize the tool and see how these play out. And then once you can do that, you'll gain a lot more clarity when you're back testing and you're going through the charts to realize that, well, if it breaks impulsively, we have a 90% probability we'll get to the low. Think about how much more you could do with your trades. Think about how that may adjust your management so you could squeeze more profit out of what you're already doing. And that is the key to break through to even more consistency. But those are two examples. Let's finish off with one more. So now we're on to the last example. We've got Euro Kiwi here. We're looking at this on a slightly shorter term. So remember, as I said, that you can apply this to longer term, medium and short term. Let's look at it on slightly more shorter term. So here on the daily chart, we take a look at this structure. We can see we've got that double top formation. And how are we moving up here? Well, it's more visible on the lower time frame. So on the 4-hour chart, what do we see? You can see this corrective structure moving up to the double top area. So if you take that bit of price and you used to just test this, like so, you can see there's a corrective structure. How do we break? We break impulsively, so then the 90% rule is activated to this area. And remembering that this isn't so much a target, it's kind of a target, but it's more so for us to be aware in that area to be more aggressive. So what I mean by that is just because it hits this area, it doesn't mean it can't go even lower, but we have to understand once we fill 90% of that as a minimum, it's likely to create either a bigger correction or change in formation. So of course, we wouldn't want to give back all that profit. So we want to be more aggressive, right? But what we could see is just another correction, another flag, and we push lower, and then we're just utilizing the structure to bank even more profit. So it's important to understand that. So as you can see there, as we break impulsively, we then move to the 90% rule, which is what we have here. So if we just play this back to here, you can see why we would have this ray line on, right? 0.1, 0.2, and looking for this to come down for the triple bottom. So as we push down, we break impulsively, and then we hit that, and we go even lower in this case. So as you can see, it can happen on a shorter degree and on the higher degree. So quite simple. Let's actually move on to the next part in this setup. So now you can see we've got this structure here. So if we were to just remove this for a second, and we was to look at this structure, if we're looking at this to come to the downside, why would we be doing that? Well, we can look at it here and see that we've got a very clear and obvious impulse, correction, continuation. So we've got a flag there. So what do we know? Well, if we put the ray line on the low, we take price back to here. If you can see that structure very, very clearly, that we will be targeting a minimum of here, if not lower. How do we know that? Next day, impulsive break. We know then on the lower time frame, bearing in mind there was entries before that, but we know as confirmation on the 4 hour and on the daily that, let's go back to this is going to push to the downside. And then what that means on the lower time frame in these areas, you're going to see even more setups. Let's go to the 1 hour chart. So as you can see, we even get a solid 1 hour close of this as well. Very strong indication. And then we push lower like so. And then we go even lower and we start to create another corrective structure. So you've got to see it from this point of view. There's always different ways to get involved in a market. We even slightly get more of a retest type formation there. If we adjust that more accurately, like so. So we get more of a retest of the back end of this. And of course, again, once you get more advanced, you can utilize the 15. But you imagine you're taking trades within these structures here and you're getting involved within this move because you know impulse correction, sell, and there's areas for you to get involved here with a risk entry. You know, if this breaks impulsively, like we had, 90% probability we'll get to the low. This is, if I'm completely honest, on a slightly messier version of what we see on the 90% rule. But it's important that you're not just looking at everything through, you know, picture perfect goggles, because the reality of the market, it doesn't behave that way. We do have those kind of gift from God setups type formations, but they're not always going to be there. And you need to learn as a trader how to try and go through the mud in that sense and read between the lines to still be able to capitalize on these trades. And it is absolutely huge. I wish I, you know, discovered the 90% rule even earlier on in my journey. How many more trades would I have held for the longer term or broken through to consistency even sooner? So by knowing that, do not underestimate the power of this rule. So go and back test that on multiple currency pairs, so you can see that these are not just cherry picked. You're going to see this happening over and over again. And once you can figure out and ask those good questions, how did it break? It broke impulsively. Perfect. Where is the beginning of the correction? So the beginning of the correction is here. Okay, so we have a 90% rule, a 90% probability that it will fill at least 90% of this. So this is a good area for me to be more active and looking at that in terms of management to see if I can, is that a good area to bank profit and not give too much back, so you can secure more for yourself and then move forward and just build that overall performance for the year. So I hope that clears those things up. And definitely, if you're not getting it straight away and you're a complete beginner, or you come from a different style, it's okay to go over these little sections over and over again. You'll pick up something new each time. As you can see, everyone, the 90% rule is powerful when you realize how many times were you holding yourself back? How many times were you cutting your trade short because you didn't really understand what was going on? Now you can see when you apply the 90% rule, it only has to fill 90% of it. And you can see how regular this happens on the higher time frames, on the lower time frames. It really, really is a powerful thing. So you'll learn to see how this operates on a consistent basis. Now moving on from the 90% rule, let's get into something called multi-touch identification. This is very, very important in the markets. The purpose for multi-touch is to help assist in identifying the current pattern and if the pattern may potentially complete. It also aids in helping us with the probable and the possible outcomes. When utilizing multi-touch, it can be highly effective when looking at both reversals and continuation patterns. The highest probability of touches is a 3-touch structure. This can be applied again to the high time frames and lower time frames. Multi-touch essentially gives us a clear picture of what pattern that is either completed and what it looks like also creates that systematic approach that we can follow on a regular basis. Patterns repeat themselves after all over many, many years of data, and multi-touch just complements that, giving us the best possible edge within the markets. But let's take a look at that on the chart so we can see what multi-touch actually looks like and how we can apply it. So now let's take a look at multi-touch identification. So this really and truly just builds on each of the components that you're learning within the strategy. This can work on the high degree and of course the lower degree. Let's start off with euro dollar, taking a look at how powerful it can be on the high degree. So within this structure, as you can see, if we just take this bit of price like so, what can we see? What's significant here? Well, if we just put a simple trend in, like you can see, what do we have? So we've got 0.1, 0.2, 0.3. Now, when we're looking at these structures, 3 touches has the highest probability. If you've got a 3-touch structure with multi-touch identification, that is the cleanest. You can have 2 touches in a sense, but you want to do it more so like this. And I'll give an example before we get into a little bit more detail. Let's say, for example, you have a ascending channel, right? So you've got an ascending structure and you're looking for particular touches of that. You may have, for example, a channel like this, like so, and you've got 1, 2, 3, but also you've got to not get this confused with, let's say, a double top. So let's say you've got 1, 2, 3 and you don't manage to get that. It doesn't mean that if this moves back up again that you have to wait for another 3rd touch. You can of course still take the double top within the pattern and then activate the 90% rule to then still get involved in the trade. But ideally, if you've got 3 touches on a structure, it's just more significant. So you can see 0.1, 0.2, 0.3, and of course we're expecting this big descending structure that you can see here for a pushback to the upside. And being able to get in at the low there is super powerful and super valuable to look for more upside. So that is multi-time frame analysis in the overall bigger picture when you drill things down. But we're looking at the larger degree, so we can combine that multi-time frame analysis of the bigger structure with multi-touch identification. So we've got 1, 2, 3, and as you can see, each thing builds on each other. All of the components do, and then it gives you even more structure with your trading. That's the higher degree. Now let's take a look at a few other examples. So next up we have Euro Aussie. So this is a more recent structure that we've been looking at. And again, looking at the multi-time frame analysis of the bigger picture, we're looking from top down. Bigger structure, impulse down, continuation pattern, impulse to the downside. So we're expecting this to move at least to this low as we're pushing now. And of course, 90% of the rule activated, and we've already cleared 90% of this already. But before that, how could we capitalize on this on the lower degree? So looking on the 1 hour chart. Well, as you can see here, we have this structure drawn in with section 1, 2, and then 3. So why does that help us? Well, it means if we're getting involved in the trade of a rejection at the top here, anywhere up here, we're looking at, let's say, on average about a 30 pip stop, and we're looking to take this to the downside. After the 90% rule is activated, then we're looking to the low. So we know that 90% of this has to be filled. Now, as you can see on the way down, 90% of this already has been filled, so we'll be more aggressive, locking in profit to around this area here. So this would have been more of a 12.5% position. Some people on the 15-minute chart, once you've got more advanced skills, maybe even slightly tighter at 25 or even lower. So you can see the difference that that can make. So 1, 2, 3, multi-touch identification. And then of course it does help if you have a pattern within a pattern even further. So as you can see within here, we have this structure of a multi-touch as well. So you have 0.1, 0.2, 0.3. So you've got 3 touches within 3 touches, which gives it even more evidence for a move to the downside. So as you can see, when you can start combining this, these are the kind of things that you want in your go-to setups, because it only takes, one of these, 2 of these in the month that hit some seriously big, consistent returns. So it's just about understanding that concept. So that is Euro Aussie. Let's take a look at one more example. So now taking a look at the last example, so we have Kiwi dollar here, and we're looking again at the bigger picture, impulse down, looking at this corrective structure to continue to the downside and hit that 90% rule as a minimum and a lot further. So as we can see, that got activated. But within here, how can we capitalize utilizing multi-touch? Well, as you can see, 1, 2, 3 touches of the structure, very clean impulse to the downside. So we expected this move lower, but let's zoom in a little bit more, because sometimes you've got to read between the lines and it's not always going to be picture perfect. So let me show you what that looks like. So essentially at the time, what would we be looking at here? Well, it wouldn't be unusual for us to have this section in like so, but as you can see, it doesn't meet there. It kind of goes through price. So what do we do here? How would we know that that is going to happen? Well, firstly, let's take a look at this part here. We just clone this, get our parallel channel, and then just neat this up. So as you can see, we're looking for those three sections. So how do we read between the lines? How does it help us? Well, we still have to look at price. You cannot take this as just gospel because it's just a trend line in that sense, but you can see there's clearly 1, 2, 3 obvious sections of this structure. So we have to look at this bit of price to see what we can work with to give us a clue as to what's going to happen next. Well, if you take that bit of price for what it is, what can we see that we have here? Well, we have a very clear ascending structure, and we'd be looking for this as a no-brainer, as a sell setup, right? So we can agree on that part. But what else do we have within there? You can see we have the mini double top. So the mini double top there for the sell. So that would initiate that. And then what we can do in the moment, that helps us to understand that, well, how is it breaking just above this trend line? Is it breaking impulsively? Is it breaking correctively? Just going back to those core basic principles of the strategy. And then the mechanics behind it is that, well, we have a mini double top. So then we can either take it as a risk entry within the structure, so just as a rejection of the double top like this. Let's just clean this up a little bit. So if we just take this trade on the risk entry, you'd be getting involved literally on the rejection around here. You'd be looking at, wouldn't be unusual for about 15 pip stop. This is where 15 would be valid in this sense. And of course, 90% rule, targeting here as a minimum, we're looking at about 19%. Let's say you got in with about a 20 pip stop, there's still 14.5-ish. Or you take it as a reduced risk, essentially on the break of the structure, slightly larger stop of 35, probably get away with 30 there once you've got the right know-how and skill set. And then again, targeting the low, slightly less, but you still, still a very respectable 8 to 9% there. And this is without scaling into the market, which of course you've learned. So this is about reading between the lines and not thinking that price is always going to be perfect. It's going to always show us this, 1, 2, 3. Sometimes it's not. It's going to show us an ascending structure that just breaks above. But we've got to learn to read between the lines. If you really want to be a great trader, it's not always going to be perfect. And again, the weekly mentorship, all of the advice that you're going to get from myself and the coaches week on week, we're going to be helping you through that. So it's just about putting in the groundwork, and this will become easier and easier to see. So that is Kiwi Dollar and the last example of multi-touch. So as you can see, what I want you to do is, again, go and backtest this, and don't just find your perfect examples. Find examples like this, so then you can actually study this bit of price action to figure out, right, so how can I capitalize on that? How can I put that in my plan? And is this a high quality trade that I will be taking over and over again at scale? Am I happy to put this position on when I'm trading larger capital? These are the questions that you want to backtest and ask yourself, so then you're more familiar with them and you can execute them flawlessly. So that is multi-touch identification. Let's move on to the next part. Now you can see the power of combining multi-touch identification with the 90% rule. It's very, very clear to see, and it really comes in that form of the probable and possible. It really helps with multi-touch. Now let's take a look at one of the most powerful psychological things in the market, something called mass psychology. So we came up with the term mass psychology to really give you an understanding as to what's really happening within the markets. Understanding this psychology is one of the most important things you can know as a trader. Essentially, we want to be on the right side of the market. Once we realize that, in order for the heavy impulses to come into the market, we will need traders caught on the wrong side. Our trading will become more profitable this way. This is where you'll see traders essentially buying at the highs and then they're selling at the lows. You may have heard this before. What this means is traders may see momentum moving to the upside or to the downside for a long period of time without being involved in the market. This naturally will create fear, the fear of missing out. So then they'll start buying in the hope that price will just continue to keep rising, or they'll start selling in the hope that price will continue to keep falling. Mass psychology becomes very, very clear when you combine patterns within your trading, as we see this happen time and time again over many, many years of data. So essentially, they see price going up, up, up and up, but they have the fear of missing out, and then they start buying at the wrong time, and then the real momentum comes into the market the opposite way. And then we're utilizing our patterns like ascending channels, descending channels, all the patterns that we focus on to assist us with that mass psychology. But what I want to do now is I want to show you this on the charts, and you can see how regular this is happening, so then you can be positioned on the right side of the market. So now let's take a look at something called mass psychology. So what is mass psychology? Well, essentially, it's the side that you don't want to be on, and this is where a lot of people are getting trapped in the markets. So essentially, what you often see is things like a resistance or a support, where people are buying the highs, selling the lows. This is where you want to avoid that, being caught on the wrong side of the market. And this is what mass psychology is. So let's get into some chart work so we can see what that looks like. So first up, we have Aussie dollar here on the daily chart, and we're going to be looking at how mass psychology can play a part within your trading, how it can help you to avoid getting caught on the wrong side. So essentially, as you can see, we've got this ray line in, and we're looking at this as 1, 2, and a potential third touch. Now, the typical type of price that you're maybe used to seeing is that if this breaks to the upside, so if we just replay this to here, and we've now broken out of what you may see as a resistance, if you like. So you have resistance, resistance, and you're looking to break to the upside. Well, if it breaks to the upside, what would you be thinking next? You'd be thinking essentially a retest to then move to the upside. So pull back to then go long. Where we're seeing something different here. We're looking at the pattern, and we're essentially anticipating this to break above, to catch people on the wrong side of the market, where the amateurs buy the highs and they sell the lows. So they buy at the highs thinking it's going to keep going up because they have this fear of missing out. But what happens, there's a particular structure that we anticipated, as you can see, multi-touch identification, 1, 2, 3, and this overall double top type formation, and a move back to the downside. So it's so important why we always say a breakout of something is one thing, but we need continuation to confirm the direction of the structure, rather than just saying, right, we've broken out with a candle, we're retesting to go long. Previous resistance is now new support. It's a very basic way to look at it. There's far more to it than that. And that may be why you've been losing for so long. So if we just replay that, as you can see, we've pushed lower, but we're anticipating this. So essentially understanding the psychology of what are the people doing that are losing consistently. We have to understand that there's the statistic that we hear, 90% of traders fail in 90 days, etc. Or now even 95% of traders fail. But you have to look at it. 90% of traders are trading support and resistance. Have we not put this together? So if 90% of traders are trading this way and 90% of people are failing, well, can't we see a statistic here that this may not be a very sustainable way to trade? And yes, it can work for some people, but more often than not, why do so many people struggle to become consistent with it? This is a question that we have to keep asking. And this is why we believe that we've seen so much progression within the community by understanding these concepts. So we can see when real momentum and real money from funds, institutional funds, etc., when the money is actually coming into the market. So we want to be on the side of that rather than on the other side. So that is Aussie dollar. And looking at that, even on a daily, and we can spot these on the lower time frames, but this is just to understand the concept of the mass psychology. Now let's take a look at a few more examples. So here we have our next example, which is Euro Kiwi, and we're looking at mass psychology again. Now, as we can see here, what do we have? We have this overall double top type formation, and again, this is more so not so much on the daily, but seeing how people get sucked in on the lower time frame. So let's go to the 1 hour chart. So on the 1 hour chart, we're looking at this as a potential break above to move back to the downside. If you were just purely resistance trading, if you like, you would take that back, you'd be looking at a break. Well, look, you can see there's momentum there. You may look at that and see, well, that was the recent high, we broke above. If we go higher, retest, and we'll be going back to the upside, looking for a next level that you may have marked on. Then what happens? Let's just move up. So we move up, we're expecting this to move back to the downside from the pattern and the structure that we see. So as you can see, rather than moving to the upside and forming continuation to confirm more highs, what do? We retrace back in. As we move back into the market, we form our little tight flags, and then we move lower and lower. So as you can see, very, very typical. People that are failing, they are buying in these areas. And the more people that buy, they get caught on the wrong side of the market. Mass psychology pushes to the downside with the momentum. So it's just understanding why this is happening, so then you can be more often than not on the right side of the market and utilize our strategy, utilize the pattern identification things that we're looking at. So for example, leading up to this, we're looking at this ascending structure, and it's not a coincidence that we push above and then retrace lower to then come back to the downside. This is why it's not always going to be picture perfect, a great sell from here. Look, it breaks above. What are we waiting for? Well, there's two things: bringing in the probable and the possible. The probable possibly may be that we form continuation and break to the upside, etc., or we retrace and then come back into the pattern. So it's just having that more neutral approach and realizing where people are being trapped on the wrong side of the market, not just on the higher degree, but also on the lower degree. But I've got one more example for you that I think that is really going to give you a much more important perspective of why you really need to be on the ball with this. So last up, we have Euro Pound, taking a look at mass psychology and understanding how important it is and how we can learn from previous price behavior. So here we are on the weekly chart. Very important to understand what happened previously. If I was to put a simple resistance, if you like, if you look at this high, what did we do? We broke above and then we broke back down. So let's look at this part and then let's look at this part next. So first up, if we're breaking above here, and we're taking price back to here, what are we expecting at this stage? And you can be honest. We get a break above, a strong break on the daily, nice close on the weekly as well, and then a retest to maybe move to the upside. So what if we told you we were expecting this to happen? And you can go back to old webinars to see this as well, to give you more of a thought process back then, but we're expecting it to break above. Why is that? It's because it catches people on the wrong side of the market, and we're looking at the price structure leading up of this ascending structure, which is a reversal to break the high and then break back to the downside. So as we break back lower, as you can see, we break back down into the pattern, but we anticipated this in the first place. So it's understanding how that repeats itself. Now let's take a look at price over here. So if we look at more recent price action and we were to look at this bit of structure here, what were we looking at? Well, if we put the ray line in, you can see that we have 1, 2. We're looking for the third touch to then potentially come to the downside. Well, what happens? We break above and then we break back in. But what's interesting is that it's the same thing. Price repeating itself. The same type of structure. That we break above, mass psychology, we drop. We break above, mass psychology, and then we drop. And even to the point where if you put this on here, we just break above and then we drop as well. But this is more significant. But even more so, if we take a look at how price repeats itself, let's take a look at this bit of price action. What can we see here? Almost identical. So you can see how it's even the same type of structure leading up to it. That we've got this correction in the middle, a move up, corrective structure, move up, breaks the high, drops. Same type of thing. What do we have there? Move up, corrective structure, breaks above this high, catches people on the wrong side of the market, and it drops in the direction that we expect. So as you can see, the mass psychology is happening everywhere. And once you can spot this, you can take full advantage of this. This is how we predict these longer term moves, by being on the ball with understanding what the mass is doing that are losing, and how can we be on the opposite side to those that are losing and position ourselves to take advantage of these full moves. And then we can go one step further, which is what we do within Falcon, looking at the previous price behavior, looking at the structure and saying, right, this actually repeated itself. It's not going to be exactly like for like, even though that was pretty identical with that price match. It's the structure that we're looking at and the psychology of why it happens in the first place. So go and back test that for yourself and see how that happens a lot, even on the lows where we break the low. Interesting how if you can just mark on here, there's the low, 1, 2, 3, 4. What do? We break below, we retrace, and we push back up. I mean, this is happening everywhere, guys and girls. And when you're on the ball with this, watch how your trading changes forever. So go and test that on as many pairs as possible and mark it on so you can see how many times maybe were you caught on the wrong side of the market, and how can you now be on the right side of the market. Now you can see how key of a role mass psychology plays a part. You may have even been involved on the wrong side many times, and now you're awake for the first time and you actually see, wow, the amount of times I used to buy at the highs and sell at the lows without even realizing. So zoom out, look at the picture and realize, get on the right side of the market, and you're going to learn that. Now, I mentioned something previously called the probable and the possible. I alluded to that within multi-touch, so I want to go into it in a bit more detail of what that actually means and what this concept is. So the probable versus the possible. Essentially, this concept will be one of the most effective thought processes to keep you in that more neutral state of mind as we work on becoming profitable. It's the best way to essentially detach as much emotional bias out of the market as possible. When we realize that we have both probable and possible outcomes, it helps us to remove that perfectionist mindset that holds a lot of traders back. What the probable means, it's the most likely outcome to occur, which generally is the highest probability attached to it. The possible, however, is understanding that this can also happen within the markets, and it still has a high criteria setup, just less likely outcome depending on the structure that you're trading. Now, this may go right over your head, so let's get into some chart work so you can see where would you utilize this concept of the probable and possible, and how does it actually keep you more neutral. So now we move on to one of the most important concepts of how we look at the markets, the probable versus the possible. So what does this mean? Well, this is something that I created years ago by understanding how to not be so emotionally attached to particular outcomes of the market. This helped me to feel more neutral. I was able to make better decisions, clear and concise decisions, and I wasn't always waiting for the market to do something that satisfied perfection. And I was able to be more flexible and understand how to still fully capitalize on trades. Let's actually take a look at how important that is and what it looks like on the charts, starting off with New Zealand CAD. So here we have New Zealand CAD on the daily chart, and you can see what I've got drawn this particular structure. Let's go to the lower degree, the 4 hour, to take a look at it even clearer. So this isn't to scale of course, but this is to understand what the probable and the possible means. So essentially, we're always expecting a probable outcome. Why? Because we're looking for the highest probability move to happen, whether that be short term, medium or long term. Let's say, for example, we're looking at this particular channel, we're looking at a reversal. The probable would be utilizing multi-touch identification, that we're looking at a third touch. So what do we have? We have 1, 2. So what could we look for? A third touch, either a risk entry or a reduced risk entry. Once we get to that area, look for a sell setup targeting the 90% rule. That would be the probable. But if you're only infatuated by, well, I'm only going to take the trade if it's there, what often that you'll see is something called the possible. The possible is still a high criteria of value that still meets your plan. So what do we have as the possible? We have the double top within the pattern, and then we can drop from here. So you imagine how important that is as a trader if you're constantly only focusing on, right, I'm waiting for the most probable outcome, and you might think in theory that sounds good because you're waiting for high probability stuff. You will miss a lot of, let's say, more towards possible moves, but those possible moves can still go on and bank you very decent percentage points. Not something you want to completely ignore because they still have a high criteria. So understanding this is the probable outcome, but this is the possible. That puts you in a more neutral state, so then you can capitalize on moves and take full advantage, rather than saying, right, nope, that has to go to the upside, that has to go to the downside, where the ego is involved, and you get something called confirmation bias. If you're thinking that this has to go for the third touch, you'll make your price action fit whatever you think. So even if this did move to the downside and it started giving us signs for a sell a little bit earlier, you would force your confirmation, and then you would find a way to make it a buy setup, and then it just won't happen, and then it will drop. You'll either take 1% loss, and then you won't capitalize on this, which is even more costly. So it's just about understanding what that means. So the probable and the possible. So now moving on to the charts of what we have here. If we take a look at this particular structure, we were looking at New Zealand CAD for a buy for a while, and as you can see, we finally broke out of this descending structure with a strong impulse, strong momentum, and then what are we looking at here? We're looking at a continuation. So natural progression in the market would be, if we follow impulse and correction, let's take a look. So we would be looking for more upside at this stage. So we get the next impulse, we're out of the structure now, and then on the lower time frames we're looking for the bull flag. We're looking for that continuation to confirm the move, and then more upside for the longer term move. So that's the probable, but what is the possible? Well, let's go to the 1 hour chart. So at this stage, we're looking for continuation. We've had entries here, we've had entries here as well, and now we're looking for more entries. But before a move happens, and I'm talking a big move, you're more than likely to see a much larger flag to get that momentum to spring to the upside, and the same to the downside. So let's see how that plays out a little bit. So we start to form more of a bigger flag, and we're looking at this stage and this interesting bit of information that we have right now, the way that natural progression is impulse, correction, right? A larger flag. What do we have here? We have a flag that starts to push to the downside. So at this stage, we may be creating something much larger. That's already a clue that the possible may happen. So let's play it a little bit further. We then start to form a slightly different structure. As you can see right now, we're forming more of this pattern, like so. Now this is coming from downside rather than impulse of a flag to move higher. So this is giving us a possible outcome that we may retest the lows again before the longer term move. Let's play it out a little bit further. As you can see, we're now utilizing pattern separation. We're at the top of this structure, and we can start to draw in a bit of structure here. And by utilizing pattern separation, we can actually see what is going on within the markets, that this is giving us right now a possible outcome that we may come to the downside here. So let's see. So we push down, and then we get the little double top within the pattern. So again, the probable was the push out continuation to move higher. The possible was that this may come down and retest the lows. And what we've utilized is pattern identification as a clue that, right, hold on a minute, something else is happening, and we may come back down to the downside. So then we're not emotionally attached thinking, well, this has to move to the upside. And then you find ways to take trades, like for example, you'll take this for a buy because you're seeing this as essentially a double bottom within the pattern, and you start to get in a little bit earlier, ignoring the fact that when you separate this pattern, which you'll again learn more and more about as the weeks go on, that this is one structure of its own that came from a move down and then started its correction, rather than starting from a move up and then starting its continuation. So it's a tiny little detail, but it's very, very important. As you can see, then we drop. So this comes at no surprise. We wouldn't be looking for this for a buy at this stage because we already had the clue with this double top within here, the impulsive breakdown. We're looking for more moves to the downside at that stage. So again, understanding the probable and the possible is one of the most important things, and you're going to see that it's going to help with your forecasting massively as well. And that is how we learn how to capitalize on this move, by understanding this. If we didn't realize what the probable and the possible was, we would just say, right, we've had a breakout of the channel, now we're looking for buys, and you see how the thought process there. Now we're looking for buys. All your mind would be doing is searching for buys, which is where confirmation bias kicks in, where we was more neutral, saying, okay, I understand that, that's the probable, but what is the possible? Can I still capitalize on that? Does that still have a high enough criteria that meets my trading plan? If it does, perfect. And you can still bank some very heavy percentage points on possible trades. So that is the probable and the possible on New Zealand CAD, and that lesson there, just to clear up some things to get your thought process. Let's take a look at a couple of more examples of what that looks like. So now you understand more about what the probable and the possible means. Let's take a look at this. So here on Euro Dollar, we're looking for buys. Why? Well, we're seeing this structure move to the upside. We have these touches here, and then we've got this descending structure. And what have we done? We've broke impulsively. Now we're looking for continuation on the lower time frame to fully confirm this move to the upside. So what do we see when we go to the 1 hour chart? Well, we've broken out to the upside. We've had some entries along the way, and now we start to form a bigger flag, which we anticipated. But at the same time, as you can see, look at how much longer this correction is lasting at this stage. Now, a good little tip to understand is that if we was to measure the impulse, like so, when the correction is 50% or over 50% of the impulse, so a much larger correction, the bigger this gets, the more neutral this becomes to actually break to the downside rather than to the upside. Because generally speaking, if we're looking for continuation to the upside, we're going to see a few things. Either the tight flags, or in the larger flag, one that has a double bottom within the pattern for a push up, or we're looking for one that has more of a impulse up, and instead of a double bottom, more of a triple bottom before it goes. But at this stage, this is much larger with the obvious big scoops and big gaps within the flag. So that gave us a little bit more of a clue. And then as you can see, it still carries on, and then we drop around this area here as we push down from here. Here we go. So as you can see, a bit of a clue, we started to hover along the trend line. So more of a essentially reduced risk entry. If you was to look at that, this would be more so on the short-term trade. Downside is limited at that stage. So would we take a trade like that? Some people have it in their plan, but generally speaking, we were looking for the buys. But look at the length of that correction compared to the impulse. It's almost as large as the original impulse. So we're not looking for something like that. And again, that was the probable and the possible. The probable was we broke out on the daily. We're looking for a continuation to push higher. We form a much larger correction that is way over 50% of the length of the impulse, which makes this structure more neutral. And then we get a hover as a clue there as a potential downside. So again, probable and the possible. But imagine again that you was only thinking about the buys, where you'd be trapped here. You'd be buying every single time, and you're ignoring something that is right in front of you, and you'll be taking unnecessary losses with the lack of clarity. We could even see within there after we started to get this kind of double top action as well within here, just like on New Zealand CAD, and then the push down, the hover. It's a no-brainer of why this happened. So again, there's justifications when you become a specialist in price action and understand exactly what you're doing. So I hope that helps on euro dollar. Now let's take a look at one more example. So to finish off with the last example, we're going to take a look at CAD yen. Now at the original part of this clip, I spoke about the lesson where I drew the ascending channel and looking at the ascending channel with the third touch being the probable and the possible with the double top. Now let's take a look at that in price action. So here we have CAD yen. Let's take a look at this structure. We were looking at this for a sell setup. And what do we have here if we take price back to around this area here? So what have we got here? We've started to get the rejection, which is why we would have that second touch. And we've got 1, 2, looking for that third touch. That would be the probable. So your mind is giving you the indication, what is the highest probability trade of playing out? If we get that completion of the 1, 2, 3, perfect. What's the possible? Well, the possible is that we get the double top. So we can look at that there to say, right, ideally we get that third touch. But if we don't, are we going to sit on our hands and just let the market constantly go without us? Or are we going to understand that there's flexibility and high criteria of trade? So the double top area to look for the sell. So let's see, let's push up a little bit. And essentially, I mean, you could argue it's a triple top in that sense, but you can see the point. It's the obvious overall second touch of this structure. And then we're looking for that push lower. So now we pushed to the downside. There was entries. A lot of people in the community actually caught this trade. And again, you can see this on the lower time frames of getting involved in these entries, and then we start to push down. So as we push down, we come up for a little bit of a retest, and then we achieved the 90% rule. This time we didn't really break this structure that impulsively, so this became quite corrective in that sense. But overall, it's the same concept of understanding that it's not always going to be perfect. You can always wait for the third touch and forever be sitting on your hands, or you can say, oh, I'm happy to take it there because that's the high probability of playing out, or I can take the double top or the triple top within the pattern that can still give me a very, very good trade to profit on. And as we play out a little bit further, we then start to form another consolidation. As you can see, just a typical big flag structure like so, and understanding that this will be followed by a big continuation targeting these lows in these areas. So it's just about understanding that concept. So if you can take what I originally taught you on the lesson and look at various patterns that we've spoken about today, then you can start to see that in a little bit more light. And what that will help you is that, let's say, for example, you're looking for a particular trade, and this doesn't always have to be with descending channels. We may have, for example, an impulse down, and you're looking for, and this is, you do this forecasting before it happens. So your mind may be saying, well, it's probable that after the first impulse, we'll get a tight flag. So you imagine after the first impulse that your mind is saying, well, I'm looking for the tight flag. You've almost confirmed that every single time there's always going to be a tight flag, but there may not be. After the first impulse, we may have a slightly larger flag. That gives you more of a probable possible mindset. Probable is that we will have a tight flag. Possible is the first flag is actually a slightly larger one. So then you can be more neutral to say, well, I could actually look for a risk entry then, rather than an impulse correction looking just for a tight flag, which would be a reduced risk on the break. So you see how it's just making you a little bit more neutral rather than very narrow-minded, which tends to ruin a lot of traders. It's not their analysis, it's not how they look at the markets. A lot of the times it's just a thought process. So this is a lot deeper psychology than you think, and it will take time, but the subconscious, with repetition, if you can start thinking more probable possible outcome, watch how your trading just changes forever because you become more neutral. And the more neutral you are, the better trader you will be. And we've seen that across the board with the community and in the trading space as a whole. So this is what you're trying to achieve with the probable and the possible, becoming more neutral, and you'll become a better trader. So I hope that helps. And then again, go and back test that, see that for yourself, and start getting your mind geared to more towards that probable possible mindset. Right, guys and girls, now you understand the probable and possible, and can't you see now, when you really get the fact that when you recognize that this is the most probable outcome, this is a possible outcome, and that keeps you more neutral, away from that perfectionist mindset, so you're not fixating on what you think has to happen, and you realize that this is what's likely to happen, and this is what also can happen. And what can happen, does that have a high enough criteria for me to focus? And remember, the most neutral traders become the best traders. They naturally have less attachment into the markets. So that is the probable versus the possible. Let's take a look at news versus structure, and how does this apply to us? Well, I mentioned in the earlier episodes about news, and we understand that news really is just a very small part, and we're aware of the bigger news, but we don't put too much emphasis on it. Often as traders, we can become very emotional when it comes to news. We let the news dictate a huge part of our trading, which can become very dangerous when we're striving for consistency. It's not that we ignore the news, but more so we're aware of the major news only, like things like Brexit. Over many years of data utilizing the Falcon strategy, you'll find that news can often just be a catalyst for a breakout of a pattern that we may have already been looking at and forecasting on a larger time frame and on a lower time frame. So after all, news will always be there, but it's really only creates a bit of volatility, but it doesn't change the direction. And it's really important to understand that, because when you realize that when you're backtesting, you're not going to backtest every single news announcement that came out. Why would you then take that into consideration in the market? There's news constantly, and these red flags, utilizing things like Forex Factory or whatever source that you're using, it's okay to be aware of that, but when you fixate on it, you hold yourself back because you'll be paralyzed from the market. So understand, news creates a volatility, not direction. So now let's take a look at something called news versus structure. So what does that mean? Well, essentially, what it means that news creates volatility, not direction. So how do we look at that? Essentially, we see news all the time and we become paralyzed by that, and we don't take trades. Now, of course, we're not advising you to trade into something like Brexit or anything like that, but understanding that rate announcements, etc., FOMC, NFP, all of these things, a lot of times the structure is just providing us the way. The structure lines up in the same direction. So news just creates that volatility to push it in the direction that we already anticipated in the first place. Now let's take a look at that visually so you can see that on the chart, starting off with dollar yen. So here we have a dollar yen here on the daily chart, and we're taking a look at this bit of price action to understand how we can utilize that thought process. So what we actually have here is a Falcon flag. So let's take that bit of price action here. And as you can see, we get our impulse down, and you can see that we've got this 3-section Falcon flag, 0.1, 0.2, 0.3, and we're looking for an impulse correction continuation to the downside to target this low. So understanding that, when we're on the lower time frame leading up to that, what would our thought process be around here? Would we be looking for sells, for buys? This is where people can get caught on the wrong side of the pattern because they're not looking at the bigger picture. So if we go to the 1 hour chart, and we can see at this point we've got 0.1, 0.2, like so, and we would be forecasting, again, probable, possible, etc., looking at these outcomes that we may reject here and drop, or what would we do after? If we break above, we're either forming continuation to then change the structure and we know something's changed, or we break above and then we retrace back in and then we go lower. So we've got a few outcomes that we're looking at here. So we're well prepared in advance. The less time that you can think in the market, the better. Remember, you're in analyst mode on the weekend, but you're in executional mode while the market is happening. You should be thinking about all of these things so you're prepared in advance. So let's see how this pushes up. So we start to create more of this ascending structure. If we just play that a little bit. So now we're moving to the upside. So this is where we have a bit of volatility from news, something like FOMC, etc. One of those, and then we push up, and this is where it gets people a little bit scared. They think, well, something's changed. The news, there's volatility. What do I do? And as you can see, it breaks straight back down into the pattern. So this goes in alignment with multi-touch identification again. As you can see, quite simply, 1, 2, well, 3, it's not perfect, is it? Because it just breaks above. This is where you have to read between the lines. How would you have anticipated this? Well, the only way is if you were studying this bit of price action in the first place, seeing that does one impulse matter, or is that just a bit of volatility where we can actually see this is just an ascending structure to the upside, and then we're looking for more downside. So it's about studying that bit of price. When you combine that with the 1, 2, 3, it's a no-brainer why we was looking for that. Now the entry type on here was actually filtered on the 15 on this one, so it's slightly more advanced in that sense, but again, you're going to get to that stage once you understand how to utilize these structures. So what I'll show you is this, just very briefly. The entry type for this one was actually here on the break, like so, for more downside here. But at this point, this is just noise. This is just volatility getting people a little bit scared. But again, we push up, we retrace back down, form the flag that you know, the type flag, and then the push lower. But you can see none of this would have mattered unless we understood the bigger picture of that this is one big impulse, one big correction, falcon flag for a push to the downside. So you ask yourself in that type of question, there happened to be a bit of volatility there with a bit of news, but yet the structure still played out as we expected. So is news creating direction, or is it just creating volatility? I'll let you decide as you see more and more of that play out, but that's why we have that saying that news creates volatility, not direction. So that's dollar yen. Let's take a look at it on another currency pair. So next up we have CAD yen. So another example. So as you can see, we've got this ray line in here, and we're looking for this 1, 2, this double top. We squeeze all the way up there in the form of an ascending structure. So we're looking at this overall ascending channel, and we're just getting people caught on the wrong side of the market. The mass psychology, we just break above the high looking for the sell. So if we go to the 1 hour chart here, let's take a look at what happened within here. So we've got the ascending structure, and we can even neaten this up even more so and go to the most recent part as we do start to break above. So as you can see, we've got this ascending structure. We just break above, so we can remove the ray at this point. And what do we get? We get an impulse, and we get the first flag. So if we looked at this, what would you look at this as? Would you look at this as a reduced risk, or would you look at it as a risk entry? I'm sure if you've learned the different of them now, you would look at this as a reduced risk, because you would take that on the break, right? So what would we do? We would set a short position on the break, and you'd have a stop roughly around 20 to 25 pips. Let's call it 25 in this case. So 25 pips, your stop just below here to trigger you in, and you'll be targeting all the way down to around these lows to fill 90% of it, which it did. So again, you would have walked away with about 4-ish% on this trade. Now, looking at it from that perspective, you would say, yeah, that makes sense, that entry, that looks good. But what if I told you that there was some CAD news coming out around this area? I think it was a rate announcement, something like that. It just shows you how unimportant it is to us, even from that. But that shows you that, well, the structure played out anyway. We have the head and shoulders type formation. We have impulse correction continuation. We have the high time frame structure. We have mass psychology, multi-touch. It's all getting people caught on the wrong side of the market for the sell. But what a coincidence that that happened to be a bit of news. So is news just creating volatility, or is it creating direction? You need to decide. All we can see is it just creates volatility. The direction is consistently playing out time and time again when we're seeing that. And you have to ask yourself, when you go and back test, let's say you was back testing this. Essentially, we've back tested this here and now, right? We've looked at the channel, we've seen how it played out. If we just take it back to, let's say, here, essentially how you're back testing, you'd be looking at it as, right, so we've got 6 to 8 1 hour candles. Would this be an entry that I would take? Right, so I've got 0.1, 0.2, that's fine. I can set the order just below, and then even if this corrects for even another 5-6 hours, I've got the entry set just in case it pushes to the downside. And then what do we get? We break below. So when you're back testing, are you going back and checking every single news announcement and cross-referencing it? You probably wouldn't do that on any strategy. So why are you doing it in a live market? So what happens is traders, they understand strategies and they say, right, CPI is coming out in about 10 minutes. I think I'm going to wait for that. Not realizing that, well, there's a pattern there that will take. And if you consistently see this happening over and over again, is it just creating volatility or is it actually dictating the direction? You can see a lot of the times the direction's already been decided by the structures that we follow. So I'm just giving you more of an in-depth analysis on that because it's so important that there's so many traders right now could become consistent if they weren't paralyzed by news. And I mean, you could go onto the news and see red flags all day long and Forex Factory and all the different kind of news calendar websites. But overall, it will do more harm than good by being paralyzed by that. You can be aware of it, but really and truly, it's not that important. What is important is focusing on things like major news announcements like Brexit, which you wouldn't trade through. And that's actually what we want to talk about next. So let's take a look at that now. So now as we look at the last piece, which is pound dollar. And I want to bring your attention to Brexit. But firstly, I just want to show you a bit of price action here. If we take this bit of price here, and we also take this bit of price, what is different with them? Let's take a look at that. So is there anything really different, or do they have a similar structure in the sense of this part? So we have big flag and we have a flag, impulse is down, previously comes from an impulse, so impulse, correction, continuation, and the one just before that, impulse, correction, continuation. So they're pretty similar, right? You can see the same type of structure. Well, this first one here, this was Brexit. But yet it's just a bigger continuation pattern that we can see. So what if we told you that we could see Brexit happening a mile off in terms of its overall direction? Not because we have some kind of special information, but more so we're just following the structure and the patterns that repeated themselves year after year after year. But do we advise trading through that? Not at all. I mean, when you're looking at that structure, like so, you've got the flag there. This is, a variation of a falcon flag, if you like, but let's just call it a big bear flag. If you look at it from that perspective, then yes, there is a impulse down, a correction, continuation, and we have the same structure here. There's more continuation, but we wouldn't trade through that. So that is the one variable. We're not going to trade while the votes are coming out or anything like that. Some people probably did, but again, you're just asking for risky business, and you're not going to do that at scale. Any kind of crazy slippage, you're going to blow your account with that type of mindset. So it's not that we're now more risky because we don't take into consideration news. We do, of course we do, but we just understand the structure more in depth than being paralyzed by it. We fear what we don't understand, but now you understand it, there's nothing to fear. So looking at it from this perspective, we wouldn't trade this, but in other situations, we would trade different news that's not as impactful. So it's just knowing that difference, and that's our one sort of disclaimer, if you like, rather than saying, well, news doesn't matter, so I'm going to trade into these big elections and things like that. That's not what you want to do. So that's why you're aware of it, but you're not taking it as your full focus unless it's something major like this. So again, unless you're going to test it literally every trade you take on any strategy and cross-reference it on every single news announcement that comes out every single day or week, you're just going to give yourself a headache and you'll never place a trade. So just understand, news creates volatility, not direction. Guys and girls, you're now at the end of episode 3. Congratulations. This is the biggest episode in the whole course, and I'm sure right now you've got tons of clarity and you're seeing the market in a different light for the first time. This is really, really important that, of course, you go over this episode multiple times. This is going to be where you really build layer after layer after layer, understanding the core principles, all of the mechanics from managing, from looking at the markets, the psychology, entering and seeing how these structures play out over and over again. And it's okay if you don't get it straight away. This is really, really an important stage in your Falcon journey. And all of our most successful students, they went over episode 3 time and time again. And remember, the penny drops for somebody at a different point. You may have to watch a particular episode within the Foundation series maybe 4 or 5 times, but it's that repetition to ingrain that into your subconscious mind. Very, very important. And guys and girls, none of this matters unless you remain teachable. As I alluded to in Part 2, remaining open. Your willingness to change needs to be stronger than your willingness to learn. So everything that you've learned right now, we now have to start building on that and putting the right habits in place so you can constantly change and evolve as a trader. Guys and girls, very, very excited for us to get into the next part as we dive now deeper into the psychology of things, but going into probability, and that's in episode 4. You're going to absolutely love it. I'll see you in episode 4.
Created with free version for non-commercial use.